Hello and a warm welcome to Econoday Unplugged on Monday, the 29th of November 2021. This week's edition is our monthly global podcast, and joining us today are Terry Sheehan on US East Coast, Max Sato in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. So last Friday, global equity markets, bond yields and oil prices all tumbled as investors responded to news of yet another, possibly even more serious mutation of the coronavirus, the so-called Omicron. Well, at this stage, it's too early to be able to assess its potential implications, and risk assets have partially rebounded today. The latest variant clearly adds to downside risk to economic activity. It also offers a reminder to monetary policymakers everywhere that it's not just about whether or not above target inflation will be only transitory. In fact, for many central banks, it's the jobs market that remains at least as important as any other indicator. And there'll be plenty of focus on that this week with updates from Japan, Europe, Canada, and of course, the US all scheduled. Okay, so before we go to the stateside, though, and let's kick off with Brian in Australia, where third quarter employment and GDP were badly hit by fresh COVID restrictions. I think it's fair to say that at least some of those measures are being lifted early. So is it reasonable to suppose expectations are for a much better fourth quarter?
Oh, that's definitely the case. Those weak numbers were very much anticipated by policymakers, and they've been pretty confident that things will bounce back pretty quickly once public health restrictions are eased. And we've already started to see that in the monthly retail sales numbers and some other indicators that are out. So I think going forward, you will see a significant bounce back. Assuming that we don't have to, establish some of those restrictions as a result of this Omicron mutation. Now, at the moment, I think authorities are playing a fairly cautious response to it, not committing to making a big response. Just waiting to see just how bad it gets and what needs to be done. But so I think at the moment the baseline scenario is still that we're going to see this further easing of restrictions that are planned to take place, and that should continue to provide a bit of a bounce in the economic numbers. Definitely expect to see the labour market improve. The housing market is still pretty strong as well, and so and as we've seen, the inflation numbers have been pretty strong as well. So I think the bias in the short term is still towards trying to raise policy rates over a long time, a longer time horizon. But with that caveat that if we see a new impact from this virus, that we'll sort of put that on hold.
Okay. If not about the inflation side of things, I noticed some comments from the central bank the other day suggesting that it would need wages growing, 3% or above for inflation to move sustainably into the RBA's target range. So is it a case that they're kind of operating now with a sort of implicit wage rate target?
Yeah, I mean, they've been talking about wage growth, for 18 months at least now, and how that is sort of the key factor that's going to drive inflation and keep inflation in their target range. So that's something that they've been talking about. They've been also analysing and researching some of the things that have been keeping wage growth unusually low over that period, and trying to work out what that means for the shape of the labour market. What we are seeing though now is that there's definitely areas of the Australian economy where there are pretty tight labour shortages, and so you would expect that to start flowing through into the wage numbers. We haven't seen it so much in the aggregate wage numbers yet, but there's definitely pockets of it. So that's a very key factor that they're looking at. But they're also, I think, trying to put a bit of cold water on this idea that they're going to have to raise rates very aggressively. Once we had the latest inflation numbers come out, markets starting pricing in quite aggressive rate hikes even next year in 2022, and so the RBA have sort of come out saying just hold your horses a little bit. We're not that worried about the inflation outlook. We think it's moving higher, but not at a really an alarming rate. So we're not looking to raise rates very aggressively just yet. So we'll just see how that plays out.
All right. One, I suppose, central bank which has been pretty aggressive with rates is obviously the RBNZ. And I've got to say, there's a long-standing series of music albums in Europe anyway. I don't know if it's on your side, called Now That's What I Call Music. And listening to the RBNZ governor the other day, I'd have to say the same about their forward guidance. I mean, they came out and said, that where are they? The central bank plans to increase its official cash rate, quote, in steady steps of 25 basis points to 2% in late 2022 and hit 2.5% in September 2023. Now, that's what I call really definitive forward guidance. So no messing about there. They're telling you exactly what they want to do. I mean, are markets accepting this at face value, or do they disagree with it?
No, I think it's broadly in line with what the markets are broadly following the direction that the RBNZ gives us. Given that it is so explicit and clear, so I think that's right. Obviously they're not 100% committed to it, and they will reassess if we do get a new sort of a renewed sort of economic weakness because of the virus. But yeah, they've always been fairly clear and transparent, and generally fairly focused on meeting their inflation target. So I think they do have a fair bit of credibility with the markets as a result of that. Now, of course, so far this year they have sort of weathered the storm reasonably well, and so that has sort of definitely given the flexibility to the RBNZ to start making that move on monetary policy.
Okay, fair enough. Last time I think you were on, we kicked off with Evergrande. What's happened since then? Seems to have kind of dropped out of the news somewhat.
The focus on Evergrande in particular has definitely receded, but there's still definitely concerns about the property market in general, and sort of no sort of sign that there's going to be a strong bounce back in that area, just because of those sort of long-standing concerns that have been sort of focused on Evergrande, but really are a broader problem for the Chinese property market. So I think that's still going to be a drag on the Chinese economy, and still going to be a factor that has to sort of weigh in on how policymakers in Beijing do respond. So that's definitely still a major reason why we're not seeing
Hello. I think unfortunately we might have missed Brian in mid-flow there. Hello, Brian.
Oh, have you got me now?
Yeah, hi.
Have you got me now?
Yep, fine.
Oh, sorry about that. Yeah, so
No problem.
No, I was just saying how the property market is still very much a focus of concern in Beijing, but there's some other factors also that are sort of dragging on the Chinese economy. You've had those measures to try and curb energy consumption. That's still an issue in parts of the manufacturing sector, and just this more broadly, this the COVID zero sort of approach that Beijing is still taking. Whenever they see a sign of a problem with the virus, they stamp down pretty aggressively, and that's still definitely weighing on the economy. So we've got a bit of a divergence really in the region. We've got Australia, New Zealand, South Korea. That's sort of three countries in the region that have tightened policy in the last couple of months, but really no sort of sign of that happening yet. With China, they're still very much got policy rates unchanged, and if anything, there is a possibility that they could lower reserve requirements for banks if they feel they need to give a bit more support.
I did notice there seemed to be a lot of speculation about a cut in their reserve requirement ratios. I think last time you were on. But on the same token, also notice we have had some slightly better numbers for October on the likes of retail sales and industrial production. So does that help to sort of reduce expectations they might have to do something?
Yeah, I mean, they're still in the background, just as part of their toolkit. So, people think that, that's still an option for them. Maybe they'll do something on fiscal policy as well. We do have sort of the annual economic policy meetings coming up in, I think, mid-December, where, they'll all come together and try and chart a course for 2022. So, they've got a bit of flexibility there. But at the moment, I think a lot of what is driving the weakness in the recovery. Even though it's starting to pick up a little bit, but what are the factors that are driving? There's just policy decisions by Beijing for perhaps other reasons. So energy consumption
Mm-hmm.
and as I said, this sort of COVID zero approach. We've had cases where there's been a single worker on a port test positive for coronavirus, and they close down the whole port. So that's obviously a key factor that's going to restrict their ability to get those economic growth numbers back up.
Yeah, as you say, zero tolerance. Okay, thanks for that, Brian. Right, let's stick with Asia though, and Japan. Mr. Sato, we've had some disappointing third quarter GDP numbers out of Japan. What are we expecting for the fourth quarter?
Hi, Jeremy and everybody. The consensus is quick rebound in Q4 because we saw a deeper than expected plunge in Q3, which was annualized 3%. So economists were looking at about 5% annualized rebound in Q4, but we're not really sure going into December because the new variant of the infections. Medical officers in Japan were had been warning people that going into the end of the year, New Year's party season, we might see a sixth wave of infections, and that's definitely a risk. Although, as we saw, North American evening time Sunday, Japan's retail sales rebounded both monthly and annually. So October was definitely a better month.
Okay, but of course, inflation is still going nowhere, is it? I think, was it the Tokyo November CPI data, at least the core numbers were still extremely weak. So on the basis of that, I mean, are the authorities actually quite pleased with the weaker yen as a means of potentially helping to get some inflation back into the system?
Definitely. Actually, Kuroda uses the term real exchange rate sometimes when it works for him. In the past he did, but now he says that's not a definite measure. So definitely the Kuroda and the gang, they would never make a comment that net effect of the weaker yen is bad for Japan, because that could really send the dollar down against the yen.
Right.
The whole point of continuing to do sometimes useless injection of cash into the system where people don't really need to borrow, or companies either, is that to keep the yen relatively weak,
Which they appear to be managing remarkably well at the moment. Okay, thanks for that, Max. Any else on Japan before we move on?
Let me just I just wanted to mention the what Brian was talking about, China. As you know, the Japanese government releases the monthly economic report. The latest was still fairly optimistic about going forward. Slow, the pace of picking up, but they did mention exports slow, now flat, because of the Chinese slowdown, and of course continuing supply chain problems. And again, the industrial production's down. So even though expected the rebound in data coming up tonight, so overall they're still hoping that gradual reopening of the economy will help people consume more, but overall it's still pretty weak.
No change there for a long time then, really, isn't it? Okay, great. Thanks for that, Max. Okay, then let's go across to Terry. Terry, a couple of podcasts ago, you were talking up fourth quarter growth in the States. We get employment update on Friday. Is it going to be consistent with that view?
Well, the Econoday median in the forecast survey is around somewhere north of 500,000. So that looks like another strong month coming in. The Federal Reserve is going to like that.
And is it going to exacerbate again? Obviously, depending upon what happens this latest variant of the coronavirus. But I mean, if we get numbers as strong as that, is that going to reinforce what appears to be happening in the marketplace? Expectations that this Fed tapering is going to have to accelerate, and we perhaps get this earlier than originally anticipated hike in Fed funds?
I think so. I mean, we just got off a long holiday weekend here, and there wasn't a lot of data last week. So it's a little hard to reassess the position, but the next FOMC meeting is on December 15th. And basically, Fed policymakers have this week to make their views known. They have what they call a communications blackout period around the meeting, and that's going to start on December 5th. So the few policymakers who've commented have basically said they're still looking at accelerating the taper. So I don't anticipate anything much different.
Okay. Brian was mentioning earlier on, it's certainly true of Europe as well, that there is a focus on wages, looking for second round effects from these really well over the top now inflation numbers. Do you know what we're looking for? At least the consensus is on hourly earnings in Friday's report, and how much weight the Fed will be attaching to that.
Well, they released the minutes of their prior meeting last week, and they were very careful to say they did not see the beginnings of a wage price spiral in there. I think we'll see above average gains in earnings. They've been running like up 0.4% to up 0.6% per month. I think we'll see something very much along those lines.
And let me ask you also about, I know the currency isn't necessarily the biggest issue as far as the Fed's concerned, but certainly for the likes of perhaps Joe Biden and co, we have seen a fairly aggressive appreciation by the US dollar now against, pretty well all the major currencies anyway. Are there any concerns about what that might do for the growth outlook next year?
Not so far. At least I haven't heard much about it. There's sort of the axiomatic a strong dollar is in the U.S. interest. Mm-hmm. And, in spite of the Trump years, many people still hold to that.
All right. Anything else from your side? We should keep an eye on this week.
Well, we're going to be getting a lot of labor force data this week. So that's going to be getting a very careful eye. Last week, we got a claims report for initial jobs claims, and it was the lowest since the late 60s. And so everybody kind of perked up about that. I think there were some seasonal adjustment factors at work there, but it's pretty clear that, at least for the US labor market, what's happening is normal end-of-year layoffs are not taking place the way they normally do because we have so many job openings and people are anxious to hire, which also means that we're likely to see far fewer layoffs after the temporary holiday workers period would normally expire, because if someone has somebody hired now and trained, they're going to try and hold on to them in January. So I expect the U.S. job market is actually going to look pretty strong for the next month or two.
And the January number, presumably on that base, if the seasonal factors are all wrong, could be a bit of a humdinger. Yep. Right. Early warning. You heard it here first. Keep an eye on that one. Excellent. Thanks, Terry. Okay, then let's stick with North America, because it's not just employment week in US. We got Canada as well. So, Max, what we had, September was a fairly disappointing month for employment, but October's number was looking pretty decent. What's Friday likely to tell us?
People are saying it's going to be a hard month to read, because some people may have dropped out of the labor market, or they're being forced to go back to look for jobs that they don't really want to, because fiscal support is being cut off. But overall, the labor market is improving, but there are mismatches.
Okay. I noticed there's a survey out from small businesses. I think it was last week. And they're talking about the possibility of seeing record wage gains in Canada next year. Be the first time sort of this economic cycle that the gains would be as large as people as apparently companies are expecting. I think they're talking about something like 4.3% price rises they're looking at now over next year as well. Now I don't know how reliable these surveys are, but given kind of all the anecdotal evidence, do you still think it's likely? I think as one Bank of Canada, a senior official was intimating last week that we could see the first hike in interest rates at the BOC as early as next April.
I'm not sure the timing is all fixed, but they're definitely trying to unwind some of the excess stimulus because, as you can see from the last quarterly monetary policy report, they stopped saying the current inflation condition is transitory anymore. So that means people and companies will suffer when both producer and consumer inflation keeps rising, especially daily necessities prices for gasoline, food, and everything. And the housing markets in Canada, as you can see, they just don't burst. The bubble doesn't burst. So I think they're definitely trying to communicate clearly that the rate hike is possible by mid of next year.
Mm-hmm. All right, fair enough. Anything else from your side, Max?
The downside risk is, of course, the floodings and landslides in British Columbia. You can see the port of Vancouver, which handles 15-20% of the national trade. We've seen a huge delay in shipments in and out of the country and within the country. So basically, BC, where I live, we're sort of cut off. I ordered 2 items by Amazon, and one was canceled because they couldn't get to this part of the country, and another one has been delayed. So definitely we're feeling the impact.
As if global supply chain dislocations weren't bad enough already. Well,
exactly.
Good luck with that. Okay,
Thanks,
Max. All right, then let's have a look at Europe. Max talked there a bit about inflation. Indeed, presume there could be more stemming from what's happening to the disruption of flows and so on. Europe, of course, ECB is still by and large talking about transitory inflation, but looking at some of the producer price data we've had out over the last few days, well, it really does make you wonder. Just looking at these PPIs out of Germany, these are all October numbers. The German annual PPI rate now is up at 18.4%. Even the core rate's half that, 9.2. In Italy, PPI is running at 25.3% up on the year, with a core rate there of just over 8%. And Spain, well, they win the prize because as of October, PPI inflation there was 0.1 percentage point short of 32%. Yes, 32%. So in terms of easing inflationary pressures, well, it's simply not an issue as far as at least continental Europe's concerned at the moment, because what's stemming from manufacturing really does suggest that these HICP, the CPI measure that the Eurozone uses, inflation numbers are going to continue to move perhaps significantly higher over the course of the next few months. And indeed, on that front, we had Germany out earlier on today. Their flash November inflation figure, that was up at 5.2%. That's the highest they've seen since the middle of 1992. And the HICP measure, so the one that Eurostat puts out for the Eurozone as a whole, the one consistent was up at 6.0%. So we'll get the flash data for the Eurozone, the HICP for November tomorrow on Tuesday. That was almost certainly now going to see another hefty increase. And it's going to reawaken these question marks about what the ECB might be going to do when it has its December meeting. It is patently obvious from some of the comments we've had of late coming out from the likes of the Bundesbank that they're extremely unhappy with the way the inflation numbers in Germany are evolving. And there's going to be strong pressure from some quarters. I suppose you can probably add in there at least Netherlands, Austria. There can be a number of calls for the ECB to make their policy less accommodative. And indeed, as far as Germany is concerned, it is a real issue for the ECB now because it's getting on for 30% of Eurozone GDP. We've had weakness coming through both in terms of the consumer sentiment numbers. At least one survey there is suggesting now sentiments slipped back to around about a 6-month low. And even the EFO survey, which had been holding up pretty well, that's now running at its weakest level since February. What growth we did see in Germany in the third quarter was essentially wholly attributable to a rebound in household spending as the COVID restrictions were eased. But of course, before we had this latest coronavirus variant, we had record new COVID cases already in place in Germany and indeed in a number of Eurozone countries as well. So this couldn't really come at much of a worse time. And it really does give the ECB a huge headache as to what to do with policy. Does it continue to maintain that what is a very, very easy stance with a view to trying to make sure that the economy does continue to recover? And indeed, bear in mind that the Eurozone economy at the moment is still about 2% or so short of where it was before the original COVID virus actually arrived. Or do they start responding to calls from the more hawkish central banks to do something about tackling inflation? It's going to be interesting to see what happens there. Out of the UK, it was a similar sort of picture over here in many ways, with prospects of a rate hike as far as the UK is concerned rising for December. People may remember all the expectations were that rates would be raised at the meeting in November, but the Bank of England surprised everyone. But since then, well, so far we've had indications that the labour market, which appear to be the only real reason why they didn't tighten this month, has continued to progress pretty strongly and by more than most people were expecting. And I guess crucially, Hugh Pill, who's the Bank of England's chief economist, he said last week that the burden of proof had now shifted and he really needed to see evidence to not tighten rather than to justify a tightening. So it does suggest there's some kind of shift in the balance of the way the MPC as a whole now is looking at the latest developments. Only 2 members of the MPC voted, of course, to hike interest rates in November. But it looks as if we've got at least 3 now. We need a couple more. We're actually going to see rates go up, but it does seem to be moving in that direction. That said, I mean, really just following on from what Max was talking about in terms of these disruptions to supply chains and so on, it is worth bearing in mind that manufacturing right across Europe is still really struggling due to the shortages of, well, certainly labour, but crucially raw materials as well. And as far as the UK is concerned, well, car production in October dropped by by 40% to its lowest level recorded for an October since 1956. So that just gives an idea of just how bad some of these supply chain disruptions are at the moment. I'll just quickly round off from my side on Switzerland, which we don't tend to talk about that much. But given what has been, I say, extreme strength really coming through from the dollar, the counterpart to which, as we talked about the other week, has really been the weakness of the euro. That's also been reflected in the strength of the Swiss franc. Whenever you see big moves coming out of the euro, particularly at times of uncertainty, and obviously this latest virus issue has added to the appeal of the Swiss franc, they do tend to move into the Swiss currency. And so we've had the Swiss National Bank intervening in the foreign exchange markets, selling Swiss franc and buying either dollars or euro to try and weaken its currency because it's getting, well, essentially it's already through the pain thresholds that most people thought the SNB had. And it really is giving them a policy headache as well. They'll be holding their quarterly central bank meeting on the 16th of December. Same day, interestingly enough, as the likes of the UK and the ECB. So that's going to make for a Super Thursday. And it's going to be interesting to see what they actually decide to do because they really are a bit of a cleft stick at the moment. Right, well, that's it for my European pieces. Anyone got anything else they'd like to say, ask, or whatever?
Nothing from the US.
Silence is golden, as for Song used to say, if it serves me correctly. Okay, well, that's not a bad effort.
All good here too, thanks.
Good, thanks, Bram. We'll let Max get on with digging himself out from the storms in British Columbia. Right, okay, well, let's wrap it up here then. I don't know, do central banks tighten to combat high inflation or do they stand pat as COVID fears rears its ugly head again? Only time will tell, but at least you can improve your chances of getting the call right by following all the key economic data and events in Econoday's global economic calendar. On behalf of Terry, Brian, Max and myself, thanks as always for listening. I hope to see you next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.